Our sponsor for this show is Santangel's Roundtable Cap Intro Events, founded by my good friend Steve Friedman. What's a Santangel? It's actually a who. Luis de Santangel was the man who persuaded the Spanish monarchs Ferdinand and Isabella to finance the voyage of Christopher Columbus, one of the greatest investment decisions in history. Originally a newsletter that published profiles of small, undiscovered fund managers in incredible detail, Santangel's made a well-executed pivot in 2012 to the conference business, including its Roundtable Cap Intro events. After 12 years and 23 events, the Santangel's Roundtable is expanding in 2024, adding a third event at Boston's Fenway Park to accompany its usual 2 roundtables held in New York. Like a traditional Cap Intro event, the Santangel's Roundtables are free for allocators to attend, include one-on-one meetings with managers, and offer opportunities to network among allocators and managers. It's no surprise then that the Roundtable attracts the most serious allocators in the world, including many of the top endowments, foundations, and family offices who rarely come together in one room. So I encourage you to visit Santangel's website, www.santangelsreview.com, to learn more and request an invitation. Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Scott Colson, the CIO of Irrational Capital. Scott has partnered with well-known academic and author Dan Ariely to build indexes based on human capital assessment, and then partner with asset managers to create ETFs that are tied to a proprietary metric they call human capital factor. In this eye-opening discussion, we covered the founding of Irrational Capital and how Scott got involved, the various ETFs that Irrational Capital has launched with Harbor Capital, what types of companies score highly when it comes to the human capital factor, the simplicity of and alpha-generating potential of using the human capital factor, and the differences between the larger and smaller cap ETFs. Scott mentioned a number of securities and ETFs during this podcast. I don't own any of them. And without any further ado, here's my conversation with Irrational Capital CIO, Scott Colson. Scott, you've partnered with the well-known academic and author Dan Ariely to build Irrational Capital. I'd be interested in hearing the story of how that partnership began.
Great. About 7 years ago, David Van Adelsberg, a financial service executive with a human resources consulting background, had the novel idea that if managers the world over say that people are their most important asset, well, then that asset should be accessible to investors the world over. So David thought that if firms managed their people well, the outcomes would be greater productivity and ultimately a greater return to shareholders. So he reached out in order to figure out how to rank all the firms in an investment universe. He reached out to a very prominent behavioral economist, one of the most prominent economists practicing today, Dan Ariely. And Dan has devoted his entire career and lifetime to understanding human motivation in the workplace. And so while Dan's studies began in the lab, they quickly transitioned to the workplace using offices and production lines. Dan's work utilizes the classic scientific setup of an experimental group and a control group. David's novel approach to systematically ranking firms required hard data. And so with their background in improving firm productivity and as well as their background in the HR consulting space, they were able to hunt down and track down this data and lock it up for the purposes of financial services. And so this data set was examined by some very intelligent folks who were at Yale at the time and concluded there's some statistical alpha in the data set, and thus Irrational Capital was born. The fundamental premise is simple yet novel. Accounting standards for human capital treated primarily as a cost. So think about your labor line item costs. Or even as a liability. So think about healthcare or pension obligations. But it doesn't measure the flip side of that, The asset that managers claim is the greatest and most important asset in their arsenal, their people. And so we seek to measure, quantify, and make accessible the human capital factor to asset managers and the world over. And so Irrational Capital is not an asset manager like many of your guests are. Rather, we partner with financial services firms, asset managers, and fund platforms so that investors can make the human capital factor an essential driver of returns in their portfolio.
Interesting. And there's been a lot of research out there cited that you guys have kind of the basis for the strategy. So I don't expect you to go through all of that, but if you were to summarize the most important outcomes of Dan's research, what are they and how do they influence the securities you gravitate toward?
Economics has always had a very difficult time reconciling its demand for rigor in the vein of physics or calculus with the fundamental object of study, which is human beings interacting with one another. And human beings do not always act in ways that are highly predictive in these sort of reduced models. And so whether it's Adam Smith's invisible hand or much more recently, the animal spirits of stock market valuations, the human being is typically erased from the purview of economics and put in some sort of economic equation form. But behavioral economics at its core recenters what's at the core of economics, human beings interacting with another, making choices and decisions, and the norms and institutions around those choices and decisions. And so it's human beings who have emotions and obligations, fear and greed, preferences and dreams, and who are the producers of the work of labor and the ideas of entrepreneurship. And so Dan's work, along with several others in the field, have shaped the way that we think about the workplace and also what that means for owners of capital. Because as some branches of economics would prefer it to be otherwise, an individual's utility curve has many non-financial or non-economic components to it that are required to be satisfied in the workplace in order for it to function well, in order for that individual to be highly productive. Those variables might include things like autonomy, competency, pride, psychological safety, and appreciation. And what managers' ears should perk up here is that the notion of a non-economic component of a utility curve, such as the need for psychological safety or appreciation, is virtually costless. It's costless to say thank you, or to have a culture where honest mistakes are treated with understanding, or where new ideas are met with earnest consideration. Dan has performed several experiments isolating the impact of non-economic parts of the utility curve. And he finds that the impact in the workplace, as far as letting people know they're appreciated, is far more impactful than things like financial rewards, like bonuses. And so companies can align their employees' utility curves, the need for autonomy, competency, and appreciation, with the companies to harness that productivity for shareholders. And we call this concept utility alignment. There's a second concept that's important to Irrational Capital, highly related to the first, and that is a very basic one in the social sciences. And so that is the distinction between extrinsic and intrinsic motivation. So the extrinsic dimension is things like compensation, paid benefits, hours of work, and investors can easily access data about these things. Stock-based comp, salary, training hours, those sorts of things. Irrational Capital's innovation here is measuring the level of intrinsic or internal motivation as well. And we measure intrinsic motivation along 6 dimensions, ranging from the enterprise level concerns such as organizational effectiveness, leadership, and innovation, to much more personal concerns like engagement and emotional connection with the workplace. There's these 6 dimensions plus the 7th being extrinsic make up the human capital factor score, which is how we rank companies for our portfolios. You can think of the typical 2x2 matrix, with the vertical axis being the level of motivation an employee has, and the horizontal axis being how aligned the employee's utility curve is to their employers, our 2 concepts here. And employees above the line are doing what it takes to keep their job. Employees below the line are trying not to get noticed, and employees near the top are highly motivated. And for the horizontal direction, Employees to the left of the middle are unaligned or misaligned with their company's utility curve. And employees to the right, looking out for themselves primarily. They may be productive, but it's really in their own interest that they're looking out for. And employees to the right are well aligned with the company. They may make personal sacrifice, or in other words, look out for the company that may not be the most beneficial to them personally. And so at the top right, we have our most desirable situation with highly engaged, highly motivated employees doing work that's perfectly aligned with what the company needs. And in the bottom left, we have our least desirable situation where we have employees who are unmotivated and not doing activities that are even remotely aligned with the company's utility function. And so ultimately, we have a clear and direct connection between the employee-employer relationship, how the employee aligns itself and motivates itself to work for the company, and the economic value creation at a firm and looking out for the shareholders' interest. And so it's that relationship and those concepts that we've borrowed from behavioral economics and applied it to finance in a new, novel way.
And since you're not, within the company, working within the companies every day, surveying their employees and eating lunch with them, right? The engagement part, the less tangible aspects of that, like whatever strong cultures or people who are highly aligned, like they seem to be hard to get at from the outside. So as you're thinking about scoring these companies on those more qualitative, harder to get factors, like how does that even happen? And I mean that's really the question. How does that happen, or do you have to kind of like look at the outside metrics and infer that this is what's happening kind of in the weeds?
Sure. So an analyst could create a culture checklist or a set of preferences that they might infer about a company based on annual reports, management conversations, or investor calls. But what that's going to tell you is a lot more about that investor's preferences and their biases than it tells you anything about what's happening in the company. And how could they possibly know? Either speaking with a few folks very high up in management, or maybe they could check one of the review sites and see how many stars it's getting from typically the bottom third of an organization. But they have no way of scientifically sampling an organization, thousands of employees at a time. And on what basis could they possibly understand that vast amount of data relative to all the other companies in the universe? They would have to do this in a scientifically systematic way across the entire universe, or as much of it as possible. And so that's the only way an analyst could sit there and say this company is better than that company along these sorts of metrics. So let's hold that thought. And the other piece is that sometimes the only way to know something is to ask. And so there's no instrument in the world that can tell you how much pain somebody's feeling. The only way a doctor can know is to ask, does this hurt? Or on a scale of 1 to 10, how painful is this, as they poke and prod your various wounds and sore spots. And so similarly, using a survey instrument that asks a person to reflect on a defined time frame about a specific psychological line item that's been found the most accurate way to gather data of this nature. And I'll just give an example. Over the past year, my manager has supported my career by providing new opportunities. And so that asks the respondents to reflect over a defined period of time, 12 months, on a highly specific psychological line item, feeling supported by something specific management has done, provided career opportunities. And so we find this sort of assessment to be highly stable versus some of the pulse surveying or topic of the day type questions that other firms might engage in. And second, how the survey is conducted is very important. The company can't just use SurveyMonkey or Google Forms. The only credible way to conduct an employee assessment is to use an independent third party who owns the data and reports their findings back to the company. And so Irrational Capital engages these firms to provide data from their on-the-ground survey process, and they use scientific sampling and ask questions that in some cases date back to 2005. And so you have to ask the same questions year after year after year in a highly consistent manner, that cross-section across the employees. And it has to be across several cycles if you want to determine that there's any kind of alpha in this sort of data. And so To have the confidence derived from these data sources, you have to use a consistent process, ask consistent questions, use scientific sampling, and have hundreds and hundreds, if not thousands, of companies in your universe. And so Irrational Capital, by engaging these sorts of firms, have accomplished each one of those objectives. That makes us highly confident in our process for data collection. But that's only half the story. Once you have the data, and the second way an analyst could be bias maximizing is in the model construction. Let's say that analyst did obtain this underlying data that Irrational Capital has, the individual survey responses that are used to construct the human capital factor. The immediate temptation is to test which questions perform the best and to assemble a portfolio of those best performing questions on a historical backwards looking basis. But that's hardly information maximizing. That's historical portfolio maximizing. To have a highly consistent information coefficient, like the human capital factor does, it's important to have as much orthogonal information that contributes to that signal's performance as possible. At Irrational Capital, we've taken a far more robust approach of utilizing all the Likert information available to us and using long-standing standard statistical analysis techniques. So we reduce more than 30 different questions down to 7 dimensions and ultimately down to a single score for each company. That single score contains thousands of responses at a company and is relative to millions of responses across their universe. And that score is designed to preserve the maximum amount of variance of information from all those questions down into that single score, which tells us about a company's human capital management. And it utilizes all 7 dimensions. So organizational effectiveness, innovation, alignment, also engagement, emotional connection, and also the extrinsic dimension that we mentioned earlier. And so all that information is contained into the human capital factor, not solely some overfit process of backwards looking regression or return maximization. We're not interested in producing a really good looking backtest. We're interested in providing access to the human capital factor, which can deliver returns to investors. And so there's many ways that a very intelligent person could easily develop a faulty data collection or faulty model here. But at Irrational Capital, we've assembled a stellar team of all-stars to ensure the entirety of the data pipeline from ingestion to final scores is dependent on the data and not some form of parameterization or our thumb on the scale. And so we've taken data fidelity as our guiding principle for algorithm design.
It's a really interesting response. And one of the first things you said is that the problem with economics is it tries to quantify, like put humans into a number, right? And to some extent, you guys are doing that same thing in terms of like whatever the aggregation of the people's feelings and survey responses about a company kind of get into one score. So how do you, it feels like there's a little bit of cognitive dissonance there where you're, you kind of recoil against that in some areas and in other areas you're embracing it. So how do you feel, how do you get comfortable with the, the idea that you are quantifying something and you're distilling it down to one number that is highly, highly qualitative?
Sure. So we can look for several ways to validate that. And so the first way that we validate that is by looking at the robustness of the signal. We'd love to see it attenuate from top to bottom, and indeed we do see that. We can talk about that some more. The second way that we want to see robustness across this process is that we want this to be better than any random portfolio we could assemble over the long term. And so we've run out Monte Carlo simulations. We've done statistical testing of each one of the individual questions to ensure that there's information there. We use a modeling process that is non-parametric. In other words, it's not dependent on any value that we place on it. This is information contained within the questions itself. And so all of that is very validating to our process. But to go to the core of your question, how can we put a number on something so qualitative? The research has shown, first of all, that this survey instrument, this way of sampling survey instruments, the most accurate way to sample folks. And so we're confident that our the workplace psychologists who have written these questions have done so in a way that conforms to a best practice. that produces a great amount of information for us. The second way that what economics, our critique of economics wasn't that numbers are used or that there's quantitative information, rather that the human has been removed from the process. And our process here focuses solely on the information contained by employee responses to their employer. We don't use a single metric, any information from a security such as a revenue growth or a leverage or return on equity. We construct portfolios solely based on responses humans have given us about their employer situation.
And so that is an incredible background with a lot of very academic and compelling statistical analysis and data analysis. And so that's a great backdrop. So maybe for the first question that would come to my mind is, like, irrespective of which of the ETFs that we're going to talk about, but like how does that turn into a portfolio? Right. I mean, maybe, I don't know if you want to give an example or you just want to talk about it in the abstract, but so you have all that. Tell me how that turns into something that, someone, an individual investor or an institution could invest in.
Absolutely. So Irrational Capital at its core, it creates indexes, investable indexes for investors to access in a variety of formats, whether it's with our bank partners, our ETF partners, or directly through us for signal provision. And so what happens is we score all the companies based on their human capital factor score. This is reflective of those 7 dimensions we spoke about, everything from organizational effectiveness down to emotional connection and even extrinsic benefits. And so those characteristics are contained in a score. So now we have a ranking of companies throughout the universe. Depending on the different portfolio construction requirements and risk management required from those portfolios, we'll select X number of stocks to be contained in that portfolio, and then utilize the weighting techniques that are required of us. Some of our indexes use market capitalization and sector weight to their underlying benchmark to reduce tracking error. Others allow for a lot more idiosyncratic return streams via equal weighting across a number of securities. Some of our portfolios have strict requirements to have representation either from the securities themselves, or if that's not possible due to the human capital factor scores, representation from the sector spider to reduce that tracking error. Other portfolios are far more idiosyncratic. So we could walk through a few if you'd like.
Sure. Yeah. I mean, I'd love to. And I think that's what people are going to be really interested in, because it's a great, it seems the differentiation of what you're trying to do, given the data set, given the nature of the way you analyze the data, that seems really compelling. But I think anyone who's listening to this would be like, all right, so what does it look like in practice?
So let's take HAPI, the Happy ETF with Harvard Capital, for example. The underlying index is the CIBC HCI. It's a human capital factor index of the 500 largest companies in the United States by market capitalization. And those companies are then sector weighted, market cap weighted, and rebalanced annually. And so that portfolio has 150 stocks. It looks a lot like the S&P 500 from a correlation standpoint, from a beta standpoint, 99% correlation, a beta of 1. So it functions very much like the S&P 500. But what you also get on top is the human capital factor through the security selection. And in 2023, that produced about, well over 600 basis points of excess return relative to the S&P. And so we see evidence of the human capital factor in action. And so it is a very careful calculation, very careful design to reduce tracking error, to make things very index-like in their field. But obviously, with that human capital factor alpha component, we're able to show that excess return. So it's really the best of both worlds with HAPI, as well as its little sister, HAPS, which is a Russell 2000-like replacement, very similar in its construction to HAPI, but for the small cap universe with some additional risk management limitations. And then we have a third ETF. This is HAPY. This is highly idiosyncratic. It's got a lot of tilt to it, and it represents the top roughly, 7.5% of the Russell 1000. So that's 75 stocks out of 1,000 So you could see that it would be highly geared towards the stocks, types of stocks that we traditionally think of when we talk about human capital, the typical software and technology, biotechnology stocks. But surprisingly, also things like financial services find their way into some of these more idiosyncratic portfolios, with financial services being overrepresented.
Let's stick with HAPI for a second. That's the larger cap fund. When I was looking through the holdings of that ETF, I was a little surprised to see, a number of the Magnificent Seven companies in the top holdings. I mean, I guess I see that there's a fair amount of, correlation with the S&P, but I guess from a human capital factor perspective, why do companies, the large tech companies like NVIDIA and Google score so highly on that metric?
A lot of these companies are very culturally oriented, and have started out much smaller companies, tech oriented. They were able to grow in a way that culture was preserved, and culture grew with them. And so we see places like Google score very high on things like autonomy, and sense of purpose and pride. People want to tell other people that they're at Google and that they're producing all the products that we've come to know and love. And so the other piece to remember here, of course, is that things are market cap weighted in this index, sector weighted to the underlying benchmark. And so even if, for example, one of the Mag 7 was very low on our list in terms of it made the cutoff, but it was near the bottom, it would appear to have representation at the top from a weighting perspective, simply because of that market cap weighting function. But indeed, companies like Google and some of the other companies we know and love, and anecdotally know that their culture is great, do tend to score very highly. Those reputations tend to be well earned. It's really once we go below the first few stocks in the index where people tend to not have as much base knowledge about the culture at these companies, and where our survey instruments really do reveal unique information. When we look at the return decomposition, about 20% of the excess return of that 600 plus basis points that I mentioned earlier for HAPI can be attributed to the Mag 7 stocks, of which I think there are about 5 of the Mag 7 in there. The other 80% of our excess return came from the other securities, the other 145 securities in the portfolio. And that shows us that the human capital factor is really doing the heavy lifting here, and it's not these other factor attributions.
So as I'm thinking about the source of that alpha and where it's coming from, I think innovation might be a space where that could be a driver. So in your experience, is there a high correlation between firms that score highly when it comes to human capital factor and the most innovative firms?
So we measure innovation a bit differently, as you might expect. Some investors might look at things like R&D spend. Some investors might look at things like patent filings, grants. Some investors might look at engineering headcount, how large the equity line item is for corporate venture. But true to our form, we think there's a much different and easier way to measure innovation across sectors and capital structure. And that's to simply ask the employees several questions regarding psychological safety, new ideas, the acceptance of them, the effective use of employee time and resources and interdepartmental cooperation. And you've sort of zeroed in on the firms that have conditions in culture for innovation. And when we construct portfolios of the most innovative firms and those with high overall human capital factor management, including innovation as well as the other dimensions, there is some overlap, as you might expect, as it's a key contributor as one of the dimensions, but not as much as you might expect. Innovation is an important driver for the returns, but organizational effectiveness and some of these other organizational dimensions, like alignment, are consistent in terms of their model contribution, in terms of how we weight what information is important. But also, organizational effectiveness tends to be a top performer when it comes to our attribution of these different 7 dimensions in terms of what's actually contributing return for the human capital factor. And so people want to work for the winning team. They want to work for an effective team. They want to feel confident and effective in their own job. And so we find that as to be one of the most important characteristics Innovation is also up there as well, but it's these organizational drivers that have really driven the performance over the last 20 years or so. But if you allow me to put a slight factor twist on the discussion, out of all these different factor definitions, and let's take the major ones out there, we've got growth, value, momentum, risk, and quality. It's quality that seems to have the most arbitrary set of definitions relative to what the factor is supposed to be telling us about a company. Typically, the investment community, when they're quantitatively rating quality firms, look for things like the leverage and earnings consistency. And to me, leverage should be defined by some optimal function for the firm, and earnings consistency is only desirable in low growth circumstances. So there's very little connection there between what they're trying to accomplish and what the factor is trying to accomplish. And so we could debate, different investors can debate quality until they're red in the face, and they do. But if we were to go and ask the average person on the street, or even the average investor in quality companies, if a quality company is one where the employees are highly engaged, highly motivated, proud to tell their family and friends that they work there, excited about where leadership is directing the company towards its future prospects, we may have trouble finding a sole dissenter on that definition of quality as one of the many, many definitions. And so when we think about human capital, we can think about it as sort of a compensation for a risk that's not there on the high end. So extra compensation with no additional risk. And on the other half of the spectrum, the bottom half of the spectrum, we can think about this as taking on additional risk, human capital risk, without any additional compensation. And so that's how it fits into that sort of factor profile. What's driving the returns? What's the source of that alpha? And that's really where we're looking.
And culture is not a static thing. It's dynamic. People walk in and out every day. Management changes, there are layoffs, acquisitions happen, and new people are brought into the culture. How do you incorporate the dynamic aspect of a culture within the human capital factor?
So as much as culture is changing every day, little by little, it also is not changing very much every day. The culture day to day, week to week is much the same at a firm. And so we've studied the half-life of culture, what it takes for an organization to move in a relative rank, a statistically significant amount. And that half-life is about 24 months, so two annual cycles. And so our 12-month sampling cycle, every 12 months, we recast the portfolio with all the new information, tends to capture the big changes, the big dynamic changes at a firm without giving prey to minor noise, a small temporary issue at a company. We tend to really capture the moves at a company that are significant and substantial changes in corporate culture.
And if you look over a longer time horizon, right, as opposed to just like whatever, to try to get yourself out of the noise aspect, what kinds of things move the score up or down at a company?
So one of the first levers management always tries to pull is the compensation lever. If they've got a cultural problem across the firm, they'll do something to try to increase the compensation, thinking that might pull the firm up the rest of these other 7 dimensions. We find that it's just not true, just not worth it, just not the case. You pay people to do the job that they're paid to do. It's all these other things that really, really matter. You've got to increase their engagement, their pride, their purpose, their sense of being in the workplace. You've got to give them the tools to be autonomous and competent and show that competency to their peers and coworkers and give them the chance to succeed. And so if firms put a lot more emphasis on these softer, harder to measure things that you really can't just snap your fingers and change, but rather have to put in the work to make sure that the management team, down to the direct management team, down to the team members, are aligned on these cultural issues. That's really difficult work, and it does take time. But those are the things that are going to be lasting and matter to an organization and pull some of those other feelings about compensation, for example, up without having to necessarily change the amount anyone is paid. They're just paid to do a much better, more enjoyable job rather than having to pay them more to do a job they don't want to do.
And if you can identify the companies with the best cultures and that score the highest, you can theoretically also find the ones that are the worst on those measures. Do you have any sense of whether or not a kind of a long good culture, short bad culture strategy would generate alpha?
So we've partnered with JP Morgan's Quantitative Derivative Strategy Desk, an independent sell-side research group that we have no commercial relationship, and provided them unfettered access to our output, the human capital factor score and signal. And they've taken those scores and done a number of research papers. There are 4 published papers, and the 5th should be out soon. And what they've studied in these papers is some of the various dimensions that we've looked at, like innovation, but also the long-short aspects of the portfolio. And the long story short here is that they conclude there's about as much alpha in the long signal as the short signal, and with very low correlation to other long-short excess return streams. Think about value growth, momentum, et cetera. And this makes really a lot of intuitive sense, in the sense that the most aligned, effective, innovative cultures with highly motivated, highly engaged employees outperform the benchmark, while then misaligned, ineffective, stagnant cultures, low morale, disengaged employees should underperform. And that's exactly what we find. And the fact that there's so much symmetry in this excess return from both the long and short return streams for human capital factor portfolios speaks to the economic relationship that we've identified between human capital factor management and value creation at a firm. And for us, it's highly validating for the signal in the process to find this mirrored alpha. And so, if we abstract one level back, we find what we were just talking about to be true, that on the long side, there's compensation for taking no additional risk, and at the same time, on the short side, there's compensation for this additional risk for which there is no return stream. And so that's why we consider the human capital factor an alpha generating factor.
And I could also think about a scenario where, kind of permutations of your strategy where you layer on some kind of value component as well. I guess we could argue all day about whether the value factor has any, validity these days. But I mean, you could argue that it just, like, hypothetically, if you could buy, if you identify the highest quality human capital companies and buy them at the cheapest, buy the cheapest valuation you can, you're kind of like, whatever, per unit of quality, you're paying the lowest price. How have you thought about that kind of analysis or strategy, kind of using the compelling data you already have?
So JP Morgan was very interested in this very question. And what they found is that the human capital factor is additive to every major factor strategy. If you take a value factor, layer the human capital factor on top, several things happen. Return improves, risk is reduced, so you get a better Sharpe ratio. The drawdowns are reduced, and you get, from a statistical perspective, you get a much higher T-stat, showing that there is real statistical alpha there, whereas these other factors tend to have T-stats at or near zero. But what's not true is pairing another factor to improve the human capital factor. It tends to stand on its own as an orthogonal return stream. And by incorporating these other investment styles that have lower T-stats, lower Sharpe ratios, larger drawdowns, you're really only detracting from the human capital factor performance. And so while we find it's great to pair the human capital factor with other factors, the inverse is not necessarily true.
And if I think about Irrational Capital's business model, right, there's asset management, there's index, which I assume people pay you for access to the index. And there's also, I don't know, a consulting arm, right, where you kind of say, well, company A is struggling. The first thing they do is try to raise compensation. you and the team, I don't know how involved you would be, but like whatever, there would be an opportunity to consult with companies as well about what they should be doing to improve innovation in the human capital factor score. Maybe just talk a little bit about the different ways that this data can be used and is being used to build the enterprise value of irrational capital.
Right. So you've identified our key line of business, which is index construction, creation, management, in which we partner with financial services firms for the distribution and fund management components, compliance, marketing, and those aspects. We found that firms who specialize in that do it very, very well, whereas we specialize in security selection in terms of constructing indexes, and we should really stick to our core competency, and we do it that way. The other way that we can engage companies is by companies coming to us for their human capital factor score. They can engage one of our data partners for a process, undergo our partner's analytical process. Well, on top of that, we'll provide them with the human capital factor score that they could choose to disclose to investors or employees or not, completely up to them. We're not in the business of improving those companies, getting in there and making recommendations. However, we do have firms that are friends of the firm that are in that business. And what the unique value that Irrational Capital brings to those consultancy firms that are very focused on, cultural change, is that often HR data gets compared to HR data for the purposes of comparing HR data to HR data. It's not very informative. And it doesn't tell us ultimately where the value for the shareholder is created. With our analytical studies of the 7 dimensions, their past return streams, the consistency throughout various cycles, we can point to the areas where shareholder value creation is most likely to occur. And so we can really help transform the conversation that often occurs when we talk about culture, is that it happens in the HR department. And we want to move this really to the CFO and CEO suite. But I think CFOs should get really interested in this concept of managing their human capital as their asset, as a true asset in the company, rather than relegating it to sort of the dark corner of HR.
And I guess when I was looking through all the material, I kept coming back to this like overweight, not overweight per se, but like this high weighting in technology and software stocks. And so I guess maybe the question that I'm curious about is why what is your theory on why more manufacturing companies, more I don't know. I mean, like I go even to stuff like, I don't know, oil and gas extraction or mining or something like that. I mean, is it something about the nature of the work? Is it something about the nature of the companies that, and their histories of why they wouldn't score more highly on a human capital factor basis?
So, right, there's a generality there, right? That tech and software companies tend to score higher or tend to be highly represented. And I think there's a couple of factors at play there. Some is just a numbers game. When you look at the Russell 1000 and you take the number of biotech firms and tech companies, software services companies, there's a number. There's a lot. It's a considerable part of the index. You go down to the Russell 2000, and biotechnology is this massive part of the index when you look at it from a per company basis. Not necessarily market capitalization, but just the number of companies, the sheer number of companies. And so there is some effect there where those companies are going to be more represented. And as we raise the bar, right? So, for example, HAPY only has 75 out of 1,000 stocks. That's a very high bar, and so and without any sort of sector preference. And so the companies at the very top tend to be companies that are intellectual in nature, right? Software engineers solving some kind of problem, biotechnology companies, improving humankind. These are lofty goals that require a lot of training, a lot of competency, ultimately a lot of autonomy in order to solve really challenging problems. And so there's something to that. That's not to say that there aren't challenging problems in manufacturing or other parts of the world or other industrial companies. Of course, those folks are solving challenging problems too. But the way that these firms tend to be designed seems to be that the core focus of these firms are sort of overcoming these challenges, and that's very inspiring for employees. The other piece of this that I do want to mention is that we don't necessarily see sector differences when it comes to human capital management. There may be ways that companies can be more effective in different sectors using different assets and things like that. But when it comes to a sense of purpose, a sense of pride, having direct relationships with your managers, having a sense of transparency and trust from leadership, a sense of appreciation that when the going gets tough, they're going to do the right thing for you. That's true at a software company in San Francisco, just as much as an oil and gas firm in Houston, financial services firm in New York, professional services firm in the Southeast. A feeling of pride is a feeling of pride. And it's up to the employees to let us know what that level is. So we're not out there telling people what a firm should look like, what a culture should look like. And rather we're letting the employees tell us whether it's good or bad. And so I think that's really important, right? That we're not overly prescriptive about what things should look like. A lot of things can be cultural personality rather than core aspects of the business. Whether a company's super punctual or overly polite are really personality traits that people can kind of self-sort into the firms that they want to be at. When we talk about value creation for shareholders, we're talking about something much more core, more true to the work being done in the workplace. And that's, again, back to things like competency, effectiveness, autonomy, pride, and purpose. And so incorporating those things into a company's culture, focusing on growing those aspects of the firm is ultimately going to lead to shareholder value creation.
Anybody knows me knows that I have an affinity for small cap. So it was interesting to me to see that you launched the Human Capital Factor US Small Cap ETF last year. What was the opportunity you saw in small caps that was so attractive?
The small cap investing is really interesting because there's sort of two ways that investors access the small cap universe. They either do it with a very broad brush in the Russell 2000, buying up every company, and there's something to be said about beta and index investing, and as an asset class, it's an easy way to access it. The other major index would be the S&P 600, which generally tends towards slightly more quality, more profitable companies, which is another great way to sort of access small caps. But what's unique about small caps versus large caps, I think, is really the analyst coverage. Analysts, and you're probably more familiar with this aspect than I am, but analysts in small caps have a lot of work to do all the time for a lot of companies. Their universe list tends to be huge, well over 100 companies, sometimes over 200 companies. The amount of information they can process about an individual company, keep track of, realize different aspects of strategy, business model, capital structure is overwhelming. And so we find that there's a lot more information coefficient in small caps simply because the coverage is so difficult. And so if you have this level of insight into a smaller corporation, let's say it's got 10,000 employees and we've got sampling on several hundred to several thousands of the responses from that company, we have a lot of insight into that company that an analyst just is not going to have. And so we saw the opportunity in small caps with Harbor Capital. We partnered with CIBC to create the small cap index. And Harbor Capital launched that ETF in 2023. And so we think it's really interesting opportunity for investors to get small cap exposure that's got a lot of correlation to the underlying benchmarks, and at the same time provides that same sort of human capital factor excess return profile that we were talking about with HAPI. It really is the little sister. And so you could pair these HAPI and HAPS into a portfolio that has both large and small cap exposure while maintaining that human capital factor excess return.
And is there any correlation between the size of a company and how it scores in terms of human capital? I mean, I guess the question is, are the scores just inherently higher for companies that have more larger resources and budgets and can't afford ping pong tables and coffee and stuff like that? I mean, just trying to get a sense of like maybe people would perceive, especially given the portfolio that in the larger cap portfolio where the tech companies are so massive and are represented well in that. Just trying to get a sense of like, is size a factor here as you're trying to determine scores?
Yeah, there is a size tilt to the human capital factor score. There's a slight size tilt towards mega caps, not necessarily large caps in general, just slight size tilt towards mega caps. And I think that has more to do with the current mega cap companies that exist right now, more so than, accident of history kind of thing, more so than anything else. The companies that we're seeing at the top of the index today are taking on, global challenges. They are solving incredible problems in compute and AI and all the interesting industries that we've seen, like autonomous driving. And they have been on the forefront of these things for decades as it relates to, the early release of cloud and some of the really interesting things happening in compute and graphics. And so I think that where we are right now in terms of what companies are at the top of the index, we are seeing this tilt towards human capital centric firms, which is a great thing overall for human capital and focusing on it. But that pendulum could swing the other way. For example, we could see a very low human capital factor asset stocks rise towards the top of the index at some point if there's a sort of cyclical change in the economy. And that may not be true then, that the top stocks in the index are human capital centric. But given this sort of secular changes that we've seen in the workplace, the level of autonomy that folks now have working from home primarily or in a hybrid work environment, the level of intrinsic motivation an employee has is going to be so much more important now and in the future than it has in the past 30 or 40 years, when people clocked in, they sat next to their manager at their desk, they ate lunch together, they went back to work, and everything was sort of done under the vision of managerial supervision. We're just not in that environment anymore. And so these aspects that we're measuring are far more important than ever to all companies, not just those in the tech space.
Something I was curious about when I was looking through the small cap ETF was that it seemed to be less technology heavy. There's even a REIT in the top 10 as a top 10 position. Why is it a historical accident also that the smaller cap portfolio looks different in terms of its tech weighting, or is there something more intentional or circumstantial about that?
So I think the thing to understand about the sort of Russell 2000 universe or the lower half of sort of the investable universe is that it's highly idiosyncratic. These companies are incredibly diverse, excluding some utilities and energy companies in the S&P 500. When you're talking about an employer size, the number of employees at a company, firms generally fall within a range, and as the largest companies, they're sort of a certain size. But when we look at the Russell 2000, we've got massive employers who just happen to have a low market cap due to, say, difficulties in the retail sector, and we also have companies with literally dozens of employees. In the case of certain REITs and biotechnology companies, holding trusts, things like that. And so you've got this diversity of employee-employer relationships and all sorts of things happening in these companies. And some of them, especially in the Russell 2000 range, you've got a lot of family control or family influence in companies that can dramatically change the workplace. And so there's just a lot of diversity here. And so some years we are quite tech heavy, software heavy in the small caps, and some years it tilts a bit more towards the industrials, a bit more towards some of the professional services, a bit more towards especially financials. And I think that different sectors over time will kind of rise and fall. And some sectors have been persistently good over time. Some sectors have been persistently bad, but are improving, like basic materials. But that's just to say, at the aggregate, those scores are low or high. When it comes down to portfolio construction, we can see, a single REIT, for example, if it gets the REIT allocation up to a certain risk management limit, it's going to be a very large allocation, especially if there's not a lot of other REITs that are competing for those spots in our REIT sector. And so that's to say that there's a lot of diversity in small caps. And I think that portfolio is highly idiosyncratic in terms of what gets represented year to year. The consistent factor, of course, is the human capital factor at its core. But we're going to see turnover there. We're going to see sector change year to year, especially as we're going from a COVID, post-COVID, and now into this sort of new normal environment. Obviously, there may be some stabilization of human capital factor scores, but this has been a period of tremendous change in the workplace.
You guys have been on this journey for a few years now. How has the progress been, in terms of building the business and AUM and getting your brand out there relative to what you expected when you first started on this journey?
So when I first started on this journey, we were actually a tiny hedge fund, and I had just been onboarded as a portfolio manager. And we were looking around the COVID environment and saying, distribution, capital raising as a tiny fund by ourselves is going to be next to impossible. How can we pivot so that we can use the human capital factor for a broader class of investors, and so that people can really access this and not just accredited or qualified investors? And so that's when we partnered with CIBC to develop our large cap index that ultimately became HAPI, and to offer that to their banking clients. And so what we saw once we took this approach was sort of a bifurcation of the investor community. On the one hand, we had allocators, professional allocators. So think of your former friends and classmates who now manage pensions and endowments, family offices. These investors have been deep into factor investing, into return stream attribution, into understanding how to build an orthogonal, highly diversified, highly dimensional portfolio, and who could see the constituent parts of what we were doing very clearly and how that fit into the rest of their portfolio. And so we have a lot of success translating that allocator interest into AUM or otherwise client engagements with these sorts of institutional allocators. There's a second community of investors, your financial advisors, and sort of the do-it-yourself community as well, the individual investor, the retail investor, who's just finding out about the human capital factor. We're spreading the word as best we can through our partners, CIBC and Harbor Capital, of course. But that's a much more broad and challenging environment in order to communicate above the noise and some of the day-to-day concerns that investors have. A lot of investors will hear something on CNBC, call their financial advisor, ask about, for example, they'll concentration at the top of the index. We're hearing a lot about that. What are you doing about that? And many investors are not yet calling their financial advisor, asking where their allocation is to the human capital factor. But given the return performance that we've had in 2023 and since inception, and given the intuitive nature of the economic argument that we put forward, we are seeing a lot of traction now in that community as we've been touring around the United States meeting with financial advisors. So we see it part of the real traction from our performance, apart from recognition of the thesis. But Irrational Capital really does serve a dual purpose. The first is what we've been talking about all day, investable access for advisors. The second is sort of moving this conversation, right, from these various communities, institutional allocators, financial advisors, and getting this conversation moved also out from the HR community into that CFO and CEO's office. And when CFOs see the increase in return on equity that human capital factor companies have despite lower leverage than the rest of the universe, and when CEOs see that firms that manage their human capital factor manage their human capital rather well outperform the benchmarks, they're going to turn to their people and say, how do we make this important at our firm too? And so really when we've been talking to these various communities, that's been a very resounding message, is that's important as well. Translating this into the everyday workers' lives.
And when you get pushback from institutional investors or even companies regarding this, like what does that look like? What is this? I'm sure people are skeptical of the importance of culture, the importance of people, the fact that you could put it all into one score. Like, what do you hear when people are saying, we have concerns or issues with what this, what you're trying to do?
Well, I think the biggest pushback that we get is, isn't this just X? Isn't this just momentum? Well, no, because we take data from the year prior and project a year forward for our securities. So even if there was any kind of momentum, it would have to happen after our measurement. Well, isn't this just growth? Well, if it was growth, it would have a lot of correlation to the S&P growth index when we look at excess returns. And there's just 8% correlation. And so it's just not there. And so I think the thing that people really have trouble getting over is this notion that you can have information about a company that isn't derived from financial information about either the company itself or the security. But when we think about what analysts do, their day-to-day job, it is incorporating all that non-financial information about a company into the financials in order to make their determinations on growth rates and everything else. And so all we're doing is making a component of that, the human capital management, explicit rather than an implicit assumption in a portfolio.
And if we're having this conversation in 7 years, what would success look like to you for Irrational Capital?
So we've got two purposes. The first we've been talking about all day. The second, I had just mentioned that we really do want to get this conversation out of the HR office and get CFOs really talking about their human capital as a day-to-day concern on earnings calls when they're speaking to investors, and investors make it a primary concern for themselves as they're speaking to management teams. So that'd be a huge success for us, getting that conversation going and really helping that transition. But when we talk about the fundamental business that Irrational Capital's in, developing indexes and helping investors access the human capital factor as a return stream, we're going to look across three fronts. We want to derive returns for investors primarily. Secondly, we'd love for the success of our products like our ETFs, our model portfolios and signal clients to grow that to a substantial AUM so that those CFOs and CEOs can easily point to it and see it in bright lights. And finally, we want human capital to be recognized as an investment factor similar to value or growth or momentum. We're very aware that there's a factor zoo out there, but even those highly established factors don't have the statistical significance found in the human capital factor. And so we think we've developed something really novel, very unique here, can't be replicated without this sort of level of data. And that makes it challenging for other investors to copy, but they can always come to Irrational Capital to get access to the human capital factor. And so that's what we're offering investors.
Yeah, I mean, I think if anything that we have discussed at length here, it is about differentiation, and the not even just from a philosophical perspective, but that unique data set is clearly a differentiator. Scott, this has been great. Let's close with the question we ask all of our manager guests. What is the most underappreciated aspect of the investment opportunity in front of Irrational Capital today?
It's the simplicity. It's the simplicity of the story. Look, highly motivated employees are going to be better for shareholders than downtrodden, beaten down, disengaged employees. It's that simple. One of our co-founders, David Van Adelsberg, likes to call it wheels on the suitcase. He's old enough to have been carrying a Hartman bag around the airport. And finally, someday, one guy had the bright idea to put wheels on a suitcase, and now we all wheel them through the airport. And so it's really that level of simplicity that asking employees how they feel about their employer is going to give us information about the future performance of that equity. It's that dead simple. And it makes it so attractive as an investment opportunity because investors can intuit and understand. They've all been in those situations. We've all been at employers where everyone is sort of leaning in, right? That we all feel that same sense of purpose and pride and opportunity. And we've also been at those employers where we're all leaning away, waiting for someone else to sort of pick up the slack and do the hard work. And we're very cognizant of sort of the two different outcomes at firms that treat employees that differently. And so we understand it intuitively. We understand the simplicity intuitively, The difficulty is the quantification and the measurement in the index design. But we've assembled such a great team that we think we've checked and excelled at every one of those boxes. And so we really are in the business of providing investable access to the human capital factor. Thanks, Ben.
Yeah, Scott, it was great. I really enjoyed covering the academic side, the practical side, throwing some curveballs at you regarding different potential strategies. So appreciate you being on Compounders. Really enjoyable.
Much appreciated, and thank you for your time.